Hey traders, Clifford back with another video on trading the charts. So about a month ago, I made a video on how to day trade or swing trade the S&P 500 without indicators. Today, we're going to actually have a part two and a continuation of that strategy, as well as how to fine tune your entries and when you can get the best risk reward with this strategy. So with that being said, let's rock and roll. Okay, so if you missed that first video, just check it out on my profile. It's called How to Day Trade or Swing Trade the S&P 500. No indicators required. Um, so basically what it was is it was a reversal strategy. And just to review from the last video, what you're looking for, and by the way, this not only works on the S&P 500, it also works on the NASDAQ and the Russell 2000 index. Those are the ones that I found that it works the best with. Um, so those are the best markets to trade for that. So here's an example. So basically, in the video, I said the best signals are usually the hammers or the shooting stars. But let's actually fine tune that. Now, in technical analysis, basically, most people are going to be like a trend trader or they're going to be a counter trend trader. So me personally, I'm more of a trend trader, so I like to try and find the trends. Um, so what do I mean by that? Well, basically, I'm looking at the daily chart, so I see that the trend is up because I can connect the lows and I can draw a trend line or whatever, right? I wouldn't want to take a sell signal because that would be against the trend. Now, I mean, I'm not saying you can't make money trading against the trend. You can, and some people are very successful at it than others. But me personally, I want to try and stick with the trend. I just find you get more better entries that way and more profits in the long term. So so here's an example of the strategy that I talked about. So basically you have a hammer here, right? So what would you be looking to do? Well, this is a reversal signal because the market opened, pulled all the way down here, and then the buyers rallied it back up before the end of the day. So just a refresher, the way you would trade the strategy is you would take a Fibonacci retracement of the candle, right? So here's the candle. And what you're looking for is the market to go back to the 50% level of this candle. So here's the high of the candle, here's the low of the candle. You want to put your order right here. X marks the spot, which in this example is 39.44, right? So how would you do that? Well, basically, you know, what I do is I just go like this. I'll put a what do they call it here? Alert, right? So I put an alert at the price I want it to be. See how I did that? Create alert. For those of you who don't know, you just right click, add alert right at the price you want. So now, and look what happened. The next day it rallied up, right? So do we pay attention to that? No, we don't, because that's not the point we want to buy at. We don't care what the market does the next day unless it alerts us. Like if my phone tells me 39.42, the market just hit that level. That's my time to jump. You don't want to hesitate. When it gets to that level, you want to jump, and you want to jump fast because the market may not stay there very long. And as you see, it hit that level, boom, rallied hard. So a trade like that would be something like this. So the way to trade it is you put your order at the 50% level, right? And then you put a stop loss underneath the low of the candle. So that's about a 50-point stop loss. You don't have to, I mean, depending on your risk management, you might want to go a little lower. Sorry, a little higher. I like to go to the low of the candle because chances are the market's never going to come back to that level. Once in a while it'll happen, but usually it won't. So I'll put my stop loss somewhere in here by the 23% level, maybe risk 30 points, try and catch 60 points, which is easy to do because remember, you're getting in here, the market only has to move 30 points, right? For it to move past where your stop was. So whether you put your stop here, whether you put your stop here, it's entirely up to you. But you always want to try and go for at least a 2-to-1 risk ratio, which means if you're risking 30 points, right, you're risking like 30 points here. You want to make sure that you don't take profit till it hits 60 points, which is about here. Okay, and you could do that. You don't even have to watch the market with this strategy. So that's pretty much how it works. You buy when it hits the 50% 50% retracement of the candle, and you put your stop somewhere below the pin. I think that's the best place to put it, and then you take profits on your profit taking strategy, right? So that's the easiest signal because so basically you got your trend, right? So now the trend is up because like you wouldn't have seen this, of course. I don't know if I could go back in time and show you. So you would have seen something like this because this hadn't happened yet. But so what I would have done is would have connect my low lines here, connect the lower highs, right? And you kind of got yourself an uptrend. So when I see this, when I see this happen, I kind of have an idea of where the market could go. So that's one way to trade the strategy. Um, but now you may not be the best at technical analysis. Not everyone is. It's a little bit like art. I mean, sometimes you're going to get it right, sometimes you're going to get it wrong. But if you're a trend trader and one of the ways which way the market's trending is you could also just look at support and resistance, and that's why you don't need indicators. So in an uptrend, the market is it's breaking through resistance levels, right? Because it's moving higher. So like you see a resistance level, here, and you see a break above it. And then you see another resistance level formed here and you see a break above it. So you see the markets constantly breaking through resistance levels. You don't want to be a seller because you're going against you're going against the trend, right? So in this example, here's another example of the strategy. So like the market broke above here, above this resistance level. Now, what was I getting at? Oh yeah. Okay. So here's what I was getting at. So this is one way to trade the strategy with the hammer, right? But what's another way? Well, another way is like if you get a huge day in the market, you could also expect a retracement. So here's an example. Let me just pull one up here to show you. So okay, here you see this candle right here. So here is a day the market broke above resistance here. Look at this. Like right here, it broke above resistance. See that candle because it closed. And that's why I always believe the best time to trade is when the market's closed because you could see what the market truly did. You're not going to be watching noise. You're going to see where it opened and where it closed. And that's what the banks look at too, I believe. But anyway, so you see this day, it closed above resistance. So that's a bullish sign, right? Now, but then the next day, look at this move. You got like a move here this next day, boom, all the way like a 60-point rally, right? Now, it's not a hammer. It's just a huge bullish candle. But it can work the same way from what I've discovered over the years because even though it's not a hammer and it didn't hammer out a bottom, it showed tremendous buying momentum. So you do it the same way. You take that long candle, right? And you draw your Fibonacci retracement zones. And look what happens. Now, so what do I do? Okay, so here, oh wait, sorry, here, no, wait, let me try and get it right. So here is the low for the candle, here's the high for the candle. What are we looking to do? Same strategy. Put in an order at this level here, add alert, 50% level, create. I don't care if I'm sleeping, right? It doesn't. Now look, the next day it didn't touch that level. Do I care? No. The next day it didn't touch that level. Do I care? No. The next day, even if I'm sleeping, when it touches that level, my order is there. And as you see, boom, I get filled, right? And again, same strategy. put my stop loss. You want to use risk management with all your trading strategies, but boom, you get filled here, right? Oh no, sorry, you get filled here. So you put your stop loss below the low of the candle, and then you wait. And as you see, the market never came back to hit your stop, right? And boom, you finally had a profit the next day, or maybe it was 2 days later that you got the profit, but still, you made a profit. Now, another way you could trade this, by the way, is using options. We haven't talked about that yet. I'll go over that in another video because I don't want to overwhelm anyone. But we'll just think about putting a stop loss for now. We'll talk about options later. But so let's look at one more, right? Here's one that just happened last week. I was looking at this one. So now we're switching to the the Russell 2000 index, right? So I'm looking at a downtrend, right? So I'm going to be a seller. But all of a sudden, something changed, right? And this is why you got to pay attention to the daily charts. The May, what is this? May 4th, it started consolidating. But then you see this level right here. This is resistance. This is exactly what we were talking about. Boom. It poked its nose up and closed above resistance on May 18th. Do I know why? No. Do I really care why? I mean, not really, because I mean, I'm just trying to make a profit in the market. I mean, okay, fine. The Russell 2000, it's the small caps, and the small caps, we're pushing higher for whatever reason versus the tech stocks. I mean, I don't really trade stocks, so I don't know all the fundamentals behind it, but all I know is the charts are telling me that there's a hammer that closed above resistance, and that's all I need to know. So now I do my strategy. I take this candle. Now this is smaller because it's the Russell. From what I understand, the Russell, its daily moves are lower than the S&P 500, but it doesn't matter. It could be the NASDAQ, it could be the Russell, or it could be the S&P. It's the same strategy. It doesn't change. Take my high for the day, take my low, right? And where am I getting in? Well, I place my alert. I don't care if I'm sleeping, right? I could be sleeping. That's fine. The alert's at 1780, right? So I put in my alert right here. Oh, why is it not letting me? No, I don't know why it didn't let me. So I put my alert right here, 1780, right? Create alert. I mean, if I'm sleeping and I get a text message in the morning, your order was the market hit this level, then I'm happy because I know my order got filled. I mean, it's not gonna wake me up, right? I mean, look, I'm putting my order right here, and look, the next day, and by the way, just so you know, in case you didn't know, the S&P 500, the Nasdaq, and the Russell, they move a little overnight, but the big movement is normally during the day session. So typically, your order is going to get filled either right early in the morning or maybe in the afternoon or something like that. But overnight, it happens once in a while, but not that often. So here you go. Here's your level, 1780. Boom, the Russell, right? It opens that day, fakes everyone out, thinks it's going to move higher. Boom, reverses, hits your order. Now you're in the market at 1780, but look, it never came back to stop you out. Your stop is way down here at 765, right? You got in at 1780, you put your stop loss at 1765. The very next day, which was Friday actually, the thing rallied to 1800. So, 1750 to 1800, that's pretty good. That's like, what is that like? That's like 20 points right there. And now today it's up again. So, I mean, you're making money, right? So, so that's pretty much how the strategy works. And again, you want to use risk management. So if you're risking 25 points, go for a profit of 50 points, put a limit order in, and then move on with your day. Like, no need to like necessarily be greedy and try and catch like 300 points. I mean, unless you're really wanting to hold long term, you could do that too. Another thing you could do, which we haven't talked about yet, is a pyramid strategy. So like you could start off one of these trades like here, right? You got the first one in here, you don't close it at a 50 points, and you hold it for more profit, right? And then the strategy happens again, and you place another position, right? And then you place another position, and then you move the stop loss of the first position underneath the support level of the second position, and then you could do that all the way till you get to until you finally get stopped out and with a profit, hopefully. The last thing I'll say is the NASDAQ, same thing. Usually when you see these big moves, the markets do retrace. So like here's the NASDAQ, here's another one, right? What's an example? Okay, right here. Look at this candle right here. Again, I mean, I'll try and put some signals in the live market next time because I know looking at the past is different than being in the live market. I'll try and if you guys want to see some live signals, I could for this strategy so you could understand more how it works during the live market trading sessions. I could do that. Just put some comments, let me know if anyone wants to see that. But if not, I mean, so here you go. Boom, here's a big day. And that's a huge day. I mean, look, the thing went from 1290, what is this? 12,974 way up. It rallied like 350 points, okay? That's a big move. So what do? We're look again, it doesn't the strategy is always the same. We're looking to retrace the move, right? So there's our levels, right? Strategy doesn't change. Find your high and low for the candle for the day. Put in your uh, put in your alert at the 50% level, right? Right there, and then boom, you're filled. And look, did the market ever come back to retest the low of that candle? No, it didn't. Now, I mean, can it come back to retest the low of the candle and stop you out and take a loss? I mean, yeah, absolutely, it could happen. But the probability of it happening, I would say, is low because usually when you get this kind of momentum in one direction, it's normally gonna keep that momentum. It's just the way the market works. I mean, typically when you're in an uptrend, the buyers want to continue to buy in at these support levels. That's why it's so powerful because these support levels attract buyers. So yeah, so that's about it for this video. I'll make another video showing you how you can use this in a downtrend. The reason I'm showing you the uptrends now is because basically we're in an uptrending market. And again, regardless of what the media and all the articles are saying, oh, the recession's coming and the biggest crash of our lifetime. The bottom line is, can all that happen? I mean, I don't know. No one has a crystal ball. It could go up, it could go down. No one knows, right? But if you just look at the charts, regardless of what all the news headlines are saying, just watch the charts because these charts don't lie. In my opinion, this is the best indicator of all. The price. Price action is the best indicator, in my opinion, in all of trading. And that's what the discovery and conclusion I've come to over the years. So, anyways, hope that helps some of you who are interested in trading the S&P 500 or the NASDAQ or the Russell. And again, you could do this strategy with futures contracts, ETFs, what is it called? The SPY or the diamonds or whatever vehicle you choose. I mean, I normally use the micro futures because I like the leverage on them. I'll make a video about that in the future if you're new to it. But again, any vehicle that you choose, any way you want to trade the S&P 500 or the Nasdaq or the Russell with this strategy should work, regardless of what type of what vehicle you're using to trade the stock indexes. So if you like the video, feel free to like, subscribe, put your comments below. Look forward to seeing you guys in the next one. And as always, my friends, trade what you see on the charts. Trade well.